G'day, Graham. Looks like we've just admitted you in. We've got a few people coming in as well, but we'll kick off straight away if that's okay. Today's session shouldn't take us too long. There were only sort of minimal announcements in the budget for clients, announcements that were new. It's been quite interesting watching the budget this year and over the last couple of years, because we've had a bit of a switch in what we would normally see from a Labor government and a Liberal government. So this year we've had the Labor government come in and be all about tightening the purse strings and making sure they're not spending too much. And over COVID, we had a Liberal government that where the spending was at record highs. And so we've had a bit of a switch, I suppose, in what you would have expected to see over the last few years. But just before we kick off, we've got our important disclaimer that says that this is all general information, that and Steve will reiterate this as well, that some of the things are proposals only. They haven't been legislated, and so if we do talk about anything here, please bring it up in more detail with us as we go forward, and also in your reviews as well with clients. Just a quick bit of housekeeping. There are not a huge number of things that have been announced, so we're probably only going to need about 25 minutes of your time. If you have any questions, please feel free to ask. If you have any issues with the quality of the sound, you can turn your video off, and that should help. Should help there. And we are recording the session, and we'll put it up on our website for anyone who couldn't attend. If you would like copies of the slides, please let us know. Happy to send them out to you. Okay, so we've split the session into four areas. So talking about superannuation, and that's something I'll go through. Then we've got a bit of a section there on what's happening with Social Security, and Steve will take you through that. I haven't actually mentioned it here on this slide, but there were no new announcements in relation to tax, but it was almost expected that we would have some unwinding of what Scott Morrison had brought in a couple of years ago. But we'll talk about how that has not been unwound, and just a reminder of what that is. And then we've also got some changes for families and housing affordability that Steve will go through. So on to superannuation first. Something that was introduced a few years ago is what's called downsizer contributions, and the government has been about making sure that we've got a great tax environment in superannuation to be able to invest for our retirement, but at the same time limiting the amount of money that you can put into super. And one of the initiatives that came out a couple of years ago was, in order to free up housing stock, was to allow individuals to put money into super from the sale of their family home. There's some conditions over that. You need to have lived in the house for 10 years, but it's a nice way to be able to boost super, especially if that's the purpose, if you're downsizing to use those funds for your retirement. The announcement is that instead of the minimum age being 60, it will be reduced to 55. And so they're just broadening that and trying to allow more people to put more money into super for their retirement, but also to free up that housing stock. We've got to wait for that to be legislated, and so that if that comes in, it'll be next calendar year at the earliest. We also had an announcement that is in relation to self-managed super funds and small APRA funds. The majority of our clients don't have these funds. They're a little bit more complicated, and it's really for people that want to be hands-on. The announcement was essentially that they're relaxing the residency requirements, and so there are rules in place that say that you can't leave the country for more than 2 years, and allow the fund to continue with the great tax benefits that super offers. That's going to go through Parliament as well. Again, it's a small thing, but I guess the government's recognising that people are spending more time overseas now. And finally, there's been no change to the super guarantee contributions. So it's been a very slow path, but we're on it. We're still on our way up to 12% contributions. I think in the mid-1990s, it started at about 4% or something like that. But the government is really trying to make sure people are able to self-fund their retirement. And so we're looking at the continuation of those increases without any change. Okay, Steve, hopefully we're able to transition here and you can take over with Social Security. I'll just stop my share so you can start yours.
I'm sure this will be seamless.
Unbelievable.
Can you see my screen there, Chris?
Looks good. Yep.
Excellent. So yeah, I have the great privilege of talking about Social Security, which is an area where, similar to the rest, we really haven't seen a lot of changes, and what we saw in the budget is more a re-announcement of stuff that we'd already heard about. But it's nice to see confirmation of a few things. So the first one we've got on the list there is some changes to the Commonwealth Seniors Healthcare Card. So that's a concession card for people that get to age pension age, but generally they have too many assets to get the age pension. Maybe they've got too much income for the age pension, but generally it's assets, and they can get a concession card that gives them cheaper scripts, a few other minor benefits, not as good as the pension card, but it's handy for cheap scripts. What they've proposed, and we've got this legislation before the Senate at the moment, so it shouldn't be very far away. What they've proposed is to increase the income limits there. So single person previously could earn a bit over $60,000. That's going to go up to $90,000. Couples from 98 up to 144. So that's just going to allow a few more people to get those discounts on scripts. So there'll be a few people that benefit from that. The majority of our clients are probably getting a little bit of age pension or below that threshold, but it's a nice initiative there. The other thing that we're seeing, and this came out of what they call it, the Jobs Summit a month or two ago. Essentially, it's a measure to try and get some more people into the workforce, because we've had a lot of shortages in the workforce post-COVID, and seeing a lot of the baby boomers starting to move out of the workforce. So what they've proposed is, at the moment, if you're on the age pension, you can earn $300 a fortnight before it reduces your pension. If you don't earn that in a fortnight, it gets banked for up to a year, and so you can earn $7,800 in a year. They're proposing that from December, if they get legislation in by then, otherwise from whenever they get the legislation in, they're going to add an additional $4,000 to that limit. And that'll be available up until the end of the financial year. There hasn't been any talk of what might happen after this financial year, so it may be a one-off thing, or we might see that extended, and that $300 per fortnight threshold increased in future. We don't know at this stage, but it's purely to encourage older Australians into the workforce. I'm not sure that it's going to achieve that, but that's what they're aiming for there. The other thing, which I think is quite a good initiative, they've proposed that if you lose your pension under the income test, you won't have to reapply for 2 years. So if you just go over the income test at the moment, if you're over that for, I think it's 6 consecutive fortnights or 13 weeks, you come off the pension, and if you want to go back on, you've got to do a full application. Under this proposal, you could lose it for up to 2 years, and all you would need to do to get back on is just update your income and assets. The other big benefit of that is that you would keep the pension card for that 2 years. So you'd be able to get the benefits of that card, which includes your free rego, discounted scripts, discounted public transport. So that's quite beneficial if you can keep that. Again, just to encourage older Australians to either stay in the workforce or return to the workforce in some capacity. One of the other changes that we saw, which again I think is quite a good change, at the moment, if you sell your house and you're planning to purchase another one, the proceeds that you get from the sale that you're planning to put into a new house are exempt under the asset test for up to 12 months. They're proposing to increase that to 2 years or even up to 3 years if it's delayed for circumstances outside of your control. And we saw with the 12-month exemption, it wasn't overly difficult to get that extended to 2 years. But yeah, they're extending that to 2 years now. The bigger change, and the thing that I think will be of more benefit to people, is that currently any money that you get from that sale continues to be deemed and assessed under the income test. So what we found is it's excluded from the asset test, but many people were still penalised under the income test. So they've proposed a change to that the deeming of that income will be limited to the lower rate of deeming thresholds, which is currently only 0.25%. So that would mean a big saving. I've got an example here of what that might mean for a couple. So we've got Bill and Mary here getting a maximum age pension, $40,000 a year. They sell their $1 million house and they're planning on rebuying something. They're downsizing into a unit. And I know a lot of people think $1 million is a lot of money for a house, but that's what we're seeing for a house these days. Around Newcastle, you're not getting much change out of that in most suburbs. Under the current rules, we would have seen a reduction of about $12,000 in their payment up until they purchased that new house. Under these proposed changes, they would continue on the maximum age pension. So that's a huge difference, and particularly if it's taking them 2 years to do that build, you're talking best part of $25,000 over that 2 years. So that's a real benefit for people that are potentially looking to downsize or to move and maybe selling before they're buying. They're also looking at freezing those deeming rates until 30 June 2024. This has already been promised, but nothing's been legislated, although it doesn't actually have to be legislated. So deeming rates are actually just changed at the discretion of the minister. So currently the lower rate there is 0.25% up to 94,000 for a couple, and then 2.25% above that. And so that will stay the same until 30 June 2024, which is quite good, even in a rising interest rate environment. The thresholds there will continue to be indexed each year. So you'll actually be able to have a little bit more that'll be in that first threshold for the next year or two, which will be quite good. Other changes we've seen, which are, again, just tinkering around the edges. If you're going on holidays for more than 6 weeks, you'll continue to get the pension supplement. That's about $56 a fortnight, I think. So previously you would have lost that at the end of that 6-week period, or for people that were moving overseas permanently. For anyone that's on DBA, total and permanent incapacity, they're going to get $1,000 pay rise, which is nice, but not a huge change. Another thing that you might have seen a little bit in the news is that they're going to reduce the maximum price of scripts down to $30. So I know some of you might be on some scripts that you're paying, $40, even $50 for. What they're going to do is reduce the maximum price to $30. If, though, the price is above that, $42.50 will still count towards your safety net. So they're not going to penalise you too much, if at all, from the safety net point of view, but you'll save a little bit on the day-to-day price. We've also saw some proposals around increasing paid parental leave. So the headline was that it's going to 26 weeks. What wasn't talked about so much is that it's 2026 before we see it get to the 26 weeks. So they're going to start adding 2 weeks a year from July 2024. So we've actually got best part of 2 years before anything happens there. They're also looking at increasing the flexibility around it. So it could be shared between parents. They're also going to allow you to take paid leave from work and get paid this on top. The trade-off, though, is that they're going to bring in a family income test. Previously, there was a personal income test. So for the mother, essentially, if they were earning more than a bit over 120,000, I think, that would not apply. They're going to bring in a family income test now, as well as that personal income, individual income test. And if the family is earning more than 350,000, they won't qualify. And again, I think that's a reasonable measure. Increasing childcare subsidy can get up to 90% of childcare costs if your family is earning less than $80,000. But they're going to also cap out childcare subsidies if at a family income of 530. The bigger change, aside from increasing those rates, is extending it to whoosh care, so outside school hours care, which is becoming a bigger thing for a lot of families where both members of the couple are working. Right, I think you're up now, are you, Chris?
I am. I will steal the screen back from you.
Yeah.
And talk a little bit about the stage 3 tax cuts. Hopefully that's come across. We've managed the transition again. Fantastic. So the stage 3 tax cuts, it was around about 5 or 6 years ago that Scott Morrison announced that we're having tax cuts, and that it was going to happen in 3 stages. And the big one is the stage 3. So where we started was that stage 1 was about introducing a tax offset for low and middle income earners. And that's already in, and that's actually about to be removed. It was part of the plan, but that's going to finish. Stage 2 was making some changes to some of the thresholds and the tax rates. But stage 3 was where the big tax cuts come in. And I have to say that I thought there were going to be some changes here. This is already legislated, but in terms of a Labor government that is generally on the side of the battlers, and understanding that they do need to try and reduce spending to slow the economy down a little bit, I thought we'd have some changes, but at this stage, Jim Chalmers has said, no, it's going to proceed. So what are they? The first thing is that we'll look at the taxable income from 20,000 to 200,000. The impact for this year, so this financial year compared to last financial year, for the people who were receiving this offset, is that they're going to end up paying a bit more tax. So the low and middle income tax offset, if you earn $120,000, then last year you paid about $600 less in tax than what you will this year. If you earned more than that, then you didn't get a benefit because that offset wasn't for you. So what we're going to see this financial year is that people in that low and middle income area are going to end up paying more tax. Next year, we're going to have, for the next financial year, we're going to have tax savings. The stage 3 tax cuts will go ahead. 1 July 2024. The stage 3 tax cuts will go ahead, and at that point, the majority of the benefit is for people on higher incomes. So what we're going to see is that if you are, earning $200,000 or more, and as Steve was talking about, you've got a bit of an issue about whether you can get your paid parental leave and all these sorts of things, then you're actually going to get a fair tax cut, a fairly big tax cut. Whether it's fair or not is another thing altogether. But what we can see here is that in the next couple of years, we're going to see people on low and middle income pay a little bit more tax. And then in a couple of years after that, we're going to see people who are on higher incomes get a fairly significant tax saving. So this was all brought in by Scott Morrison a few years ago and legislated. And so it's up to the Labor government now to change that legislation. If they do nothing, it will just come in. To give you another idea of the benefit or the tax saving that people will receive, you can see there that if you're on those lower incomes, you get virtually nothing. But if you're earning, say, $200,000 a year or more, then your savings is going to be around $9,000 a year. And that's why I thought we were going to see a change there, because it would be relatively easy to take something away for a Labor government to take something away from high income earners that they haven't got yet. But that's not how it panned out. So whenever you hear about this stage 3 tax cuts, that's what it's all about. At this stage, they've survived, but I wouldn't be surprised if we continue to have poor economic data come out and the government's looking for ways to reduce the outlays that they have or to increase taxes. That'd be a way that they could get access to it. So it's still on at this stage, and people that are earning $200,000 or more will be quite happy and hope that it continues. One other thing that we found interesting was that the government is looking to push electric vehicles, and so it's possible for you to salary package any sort of expense, but the government doesn't want people, say, having their kids' school fees paid for by work and avoiding tax, or a whole series of things like that, where the government has said, all right, there's some things that will allow your employer to pay for on your behalf, but there are others we won't. And for the areas that they'll only allow a partial benefit or no benefit at all, they apply fringe benefits tax. So what they're saying is that the plan will be that if you purchase an electric vehicle through your salary, then you won't have to pay that fringe benefits tax. There is a little bit of a disclaimer there. It has to be below the luxury car tax of about $85,000, and hybrids aren't counted. Steve and I were talking about this earlier, and we're not experts on electric vehicles, but most of the ones we're sort of aware of, neither of us own one, but most of the ones that we're aware of, they're going to be around $60,000 or more, and so it's an expensive thing. Yes, there'll be an incentive there where you could potentially get a tax benefit, but you still got to spend a lot of money. So we'll wait and see how that pans out. Steve, I think I'm back to you.
I think you're right, Chris. And there we go. Can you see? Oh, I'm still on the tax cuts. That's pretty good. Now, why won't that change? Okay, so housing, one of the big aims of the budget was to address the housing affordability issues. There was a lot made of a housing accord where they're going to speak to superannuation funds and institutions about how they can help fund affordable housing. There didn't seem to be any sort of detail or substance to that particular claim, but they have an aim of creating 1 million new houses in the 5 years from 2023 or something along those lines. I'm not sure these initiatives will achieve that, but there's a few things in here worth talking about. So there's this regional first home buyers guarantee, and I had to double check, and in this particular case, Newcastle counts as regional. It seems to be up for debate whether we're regional or metropolitan, depending on what suits them. That to qualify for that, as a single person, you need an income under 125, under 200 as a couple. You can buy a house worth up to 900,000 in Newcastle Lake Macquarie, $750,000 elsewhere. You can buy that house with a 5% deposit and you don't have to pay lender's mortgage insurance. The government's effectively guaranteeing the other 15% that would normally be covered by lender's mortgage insurance if you didn't have a full 20% deposit. That scheme is going to allow 10,000 places between 1 October and 30 June 2023. So it's actually a short period of time that it's actually they're talking about at this point. There's also this Help to Buy scheme, which was one of the schemes that Labor came out with in the run-up to the election. This was the shared equity scheme in response to the Liberals' proposal of being able to use some of your super to buy into a home. So to qualify for that one, again, it's a first home buying scheme. You've got to be earning less than $90,000 or 120 as a couple. If your income goes above those limits, you may have to start repaying the government. So the idea is you're only eligible for this while you qualify for it. You can buy a house in this case with only a 2% deposit, with the government stumping up 18% as well, not necessarily stumping it up, but as a guarantee. Oh, in this case, they will be stumping up money. The government owns part of the house, up to 40% for a new build, I think 30% for an existing house. So it's a fair chunk. You can buy the rest from the government later, even if you don't go over those income limits. You can choose to buy in 5% increments. You can choose to buy more later. You pay all the ongoing expenses of the house. So it's an interesting scheme. The details are still a little bit hazy. We haven't seen any legislation introduced to know the finer detail, but it's definitely something that may help people on slightly lower incomes that may have been struggling to get into the housing market with the prices as they stand, that will potentially have an opportunity through this. That's again running from October till June. I think they're looking at 40,000 places in that over that period. Interestingly, there's actually a very similar scheme running in that's proposed for New South Wales from 2023. So that's the changes that we had there. From here, we still have a process of passing all those things through Parliament. And this is where we've seen real stumbling blocks over probably the last 5 years, or probably up to 10 years now. A lot of proposals being made in budgets that have never actually come to fruition. So very much take these things with a grain of salt, and until they're actually legislated, don't take anything for granted. There's not necessarily any opposition to a lot of these things, but we've seen in the last few years that some of them just get lost along the way, and priorities change, and legislation never even gets introduced, or it gets lost in Parliament. So we'll wait and see what actually happens. And of course, anything specific, have a chat to us, and we can talk about if any of this is relevant to your circumstances or anything that needs to change. I don't think there's many people that are going to, feel a great deal of difference after this budget. And I think that was very much the aim of it. It's really to set a baseline going forward, and so they can blame everything that's happened up until this point on the Liberals, and start fresh from there. I think they'll still blame everything on the Liberals, but they at least have a baseline to start with. So I think that's all we had to cover. Was there any questions from anyone?
No.
Okay.
Haven't had anything come through in chat.
Righto. If we don't have any questions, we'll leave it there.
Thanks very much, everyone.